Sure. Yes. Maybe I can do something on my side.
Good morning, everyone. Thank you for joining us. Today we'll have Leslie Appleton-Young, our Chief Economist, discuss the 2018 housing market forecast. Just a few housekeeping items. This webinar will be recorded. I'll be sending a link with the slides and the recording, and once the video is done processing, it should be out to you guys by tomorrow, hopefully. And if you guys have any questions throughout the webinar, please use the little chat function in the widget, and I'll try and answer them throughout the webinar, and if not, I will turn them into Leslie after the webinar. With that, here's Leslie.
Good morning, everyone. Thank you for joining us. I hope that some of you were able to attend the expo in San Diego, but for those of you that were not, I'm happy to go over our 2018 forecast. If you have any questions, you can enter them on the screen, and my email address is leslie.a@car.org. If you have any questions, I'd be happy to answer them. As well. It's not working. Is there? Okay. I like to start every year with a little bit of accountability. What did we say was going to happen in 2017? What was our forecast? How did 2016 actually end up? And how do we compare with what we project to happen for this year? So looking just at our 2017 forecast, a year ago, we thought sales would be up modestly, 1.4. We think we're going to be about that, 1.3% increase. Median home price has actually been stronger than we anticipated. We projected a 4.3% increase. We're coming in for the statewide median at a gain of 7.2%. And as I'll go through later in my presentation, there is a much more robust growth going on at the entry-level end of the market than at the luxury end of the market. In terms of an interest rate forecast, we kind of lucked out this year, and our forecast for the average mortgage rate for the entire year was 4%, and that is also our projection. Housing affordability flat at 29%, being able to afford. I mean, we're on target with our forecast, and then the GDP will come in just a little less strong than we anticipated at 2.1%, and it could even be a little bit below that. The hurricanes that devastated the southern part of the country in September will certainly take a bite out of economic growth in the third quarter and fourth quarter data. This is a slide. It says what to expect in 2018. A year ago, it said what to expect in 2017. And I put it back in because I wanted you to see the highlight, California economy outperforming the nation. And then I added, maybe not. And this is just a precursor to an argument that I'm going to weave throughout my remarks, and that is the lack of affordable housing in California is impacting our competitive edge. CAR has been talking about this issue for at least 30 years. The idea that housing is the Achilles heel of the California economy is not new, but it's coming back with a vengeance as we look out over the next 3 to 5 years, because people just, particularly millennials, potential first-time buyers, are just having such a difficult time getting into the overall market. Before I get into the California housing market, I just want to lay the foundation for a economy nationally that continues to move ahead at a relatively modest pace. This recovery has been the opposite of a V-shaped bottom and come roaring back. We've seen growth between, 1.6 and 2.5% for most of the last 6 to 7 years. Second quarter growth was 3.1%. We're expecting it to be lower in the third quarter because the natural disasters I just alluded to. Consumers are definitely in force in the market, and the job market remains very, very tight, with an unemployment rate well below what I was taught was the normal natural rate of unemployment, which I think back then was about 6%. So you can see that we're well below that. So just kind of a little bit more data around those key points. You can see overall economic activity nationally having a lot of quarter-to-quarter volatility. But if you look there on the left-hand side of the screen, you can see the 1.5 to close to 3% that we have been experiencing during this overall recovery. Consumer spending is approximately 2/3 of the economic growth that you just saw, and consumers have been out in force. They've got fairly good confidence. Here's the consumer confidence. We had a Trump bump in the positive direction after the election last November, and even though there's been a slight retreat since then, we're certainly on a much more positive note than we were several years ago. So that's positive. And if you look at what's going on in the stock market, last week we hit historic highs. So you've got consumers looking at their personal balance sheets. They're seeing, for those of them that have a stock portfolio, they're very encouraged by those data. And for those that own homes, they've seen a recovery and then some in many areas of California in terms of the value of their home. So all of that feeds into confidence and consumer spending. What's happening with rates? Well, one thing that most forecasters agree on is that we are going to see higher rates in 2018. We've actually been saying this for the last 4 years, and we've been continually disappointed to a certain extent. You know, the Fed has been very clear that they have wanted to see a raise in rates. They want to normalize monetary policy. They want to be in a position that when we get into the next downturn, they've got a little bit of muscle in terms of monetary policy and reducing that Fed funds rate. We're looking towards an increase in the Fed funds rate in December and 2 or 3 increases in 2018, along with the long anticipated selling of the treasuries and mortgage-backed securities portfolio that they built up during the overall recovery. All that being said, rates are extremely attractive, and that's really one of the problems. You know, when you have an affordability crisis, when mortgage rates are below 4%, you know that all of your vulnerabilities and risks are on the downside in terms of what an increase in rates will mean. So even a modest increase in rates next year is going to be a struggle for the housing market and affordability in general. A couple words about the labor markets. I mentioned earlier that we are in an extremely tight situation. California's unemployment rate tends to be about a full percentage point higher than the nation as a whole. But as you look at this graphic, you can see both have come down significantly since the peaks in 2009 and 2010. There is a tremendous amount of variability statewide, with the Central Valley still reeling from the declines in oil prices, but also struggling from an inability to fully participate in the tech information age revolution. So the highest unemployment rate in California remains in Kern County, Bakersfield. The lowest in the Bay Area was San Francisco, down at 3.3%. We have put back in this state all of the jobs that were lost during the recession. We're actually up 1.1 million jobs. But here's the concern. Since 2012, the growth in jobs in California has exceeded the national growth rate until this spring. In April and May of this year, we grew at a slower pace. And as we look at potential fissures in the California economy, I think we have to look to that point, that our competitive edge in terms of job growth is really started to play itself out. In terms of the regional disparities, the Bay Area tends to grow faster, but the Southern California economy is about twice as big. So the actual number of jobs created over the last 12 months, we've had about 101,000 new jobs in Southern California, about twice what we are seeing overall in the Bay Area. So those are the two primary drivers of job growth in the state, with number 3 being the Central Valley with a gain of 1.7% with 36,200 new jobs over that 12-month period. Where are the jobs coming from? Construction. We need construction workers. We needed construction workers before the fires in Northern California and Southern California. We need them now even more. And this is actually a national issue with the recovery from the hurricanes. Many of the people that were involved in these trades in 2005 and 2006 had to find other jobs with the meltdown in the market, and now we desperately need them back. So to see the big job growth in construction is very, very encouraging. That's where the demand is. Looking at the bottom, the drop in non-durable goods is something that's been going on for 4 decades. It's the shrink in manufacturing. It's the offshoring of those plants to cheaper labor, and also to AI and robotics. But note that right above that, a slight decline in job growth in professional, scientific, and technical services, which you can read as engineering, software engineers, all of that kind of tech component actually declined a little bit in August. And again, as you look at possible tipping points, possible fissures in the economy, you have to look right there. You know, how can a company expand when its workers have to spend 4 hours a day on a bus commuting to and from the job? No matter how luxurious the bus is, it becomes a little bit of a problem. So we're seeing expansion in areas, and not that Silicon Valley is going to pick up and walk to another state. I'm not suggesting that at all. But when I think about the incremental growth in some of these companies, I see growth going on outside of California, largely because of the housing issue. Now here we have a summary slide that just says the U.S. economy is going to be growing a little bit faster. In 2018, we've got tax reform that is going to provide a little bit of stimulus there, and we also have all of the recovery efforts from the natural disasters, which is going to provide some growth as well. Job growth will be a bit slower. Again, that's very understandable given how tight the labor market is, a lower unemployment rate. CPI has been inching upwards this year. We're actually right at the 2% target for the Fed, and we see that tightening up a little bit more next year. Real disposable income a little bit higher, again, reflecting finally the tightness in the labor market. And rates, again, for the 5th year in a row, CAR is projecting higher rates in 2018, and there is every indication that that will be the case. However, what we have learned is that as one of the key players in a global capital market, when there is difficulty abroad, there are capital inflows into the United States. So regardless of what the Fed's direction is, when capital flows in, it's going to impact our rate. So that is just a way of saying there are exogenous events that we can't identify, but we can anticipate that those things might happen, just as they have overall in the past. Here is a brief summary of where we see California in 2018. Job growth also slowing because of the tightness in the market, unemployment down. Next year will be a banner year for the population of California. We will be reaching 40 million residents. We had 20 million residents in 1970. So since 1970, we will have doubled the population of the state, and real disposable income higher, reflecting the tightness in the job market at 4.3%. So that's the kind of foundation on which the housing market in California will be resting. So let's start with a very long-term view. This goes back to 1971 and shows closed escrows of single-family homes starting in 1971. The red line is membership in the California Association of Realtors. And if you eyeball the graph, hopefully you can see the pattern where the market peaks and 2 years later membership peaks. The market bottoms and 2 years later membership bottoms until 2013 and 2012 when the market dropped, but membership went up. And we have had kind of a challenge forecasting membership as well. We've been below target for the last several years. In 2018, for the first time since 2006, membership will be above 200,000 California realtors, and I want to welcome each and every one of you. So, how's the market? When people ask me that question, I immediately go to sales. I immediately go to the number of transactions. And in terms of the state as a whole, my answer is typically, I'm a little underwhelmed. I'm a little underwhelmed. If you look at the slide and look at the last 7 or 8 years, you're probably taken as I am with the fluctuation within a relatively narrow band between about 400,000 and 435,000. And it's interesting because if you look at that period of time, you realize that we've had job growth, we've had income growth, we've had a return of household formation as millennials have gotten jobs and moved out from their parents, and we've had the historically low mortgage rates that we talked about earlier. So even with all of that, we have fewer transactions today than when we had only 30 million people living in California. Let me say that again. We have fewer transactions in the real estate market than we did when we had less population, significantly less. So what's going on? Well, it's not too hard to explain. We don't have enough supply, and what we do have is very expensive. It's really those two things. We aren't building enough new housing stock. The existing stock is not turning over like it did in the past. And the median home price in California, and let me get to that right here. The median home price in California at $565,330 in August is twice the national median. So there it is in summary form. How are we doing with respect to prices? Well, we had a 60%, almost 60% drop from 2007 to 2009. And since that time, we've had a pretty good recovery in California, but it's varied quite dramatically by region. On a year-over-year basis, we're up mid-single digits, kind of on the upper end of that, year-over-year, about 7.2%, and that's also our projection for growth for the year as a whole. You can also see, as you eyeball this chart, the region, the kind of seasonality in median home prices, with the peak in the summer at the peak of the spring home buying season, and a fall off in the fall and winter months. So what I've got now as I go through the state is just a comparison between where median prices are today by county and where they were during the peak of the 2005, 6, 7 market. So for the state as a whole, the prior peak was in May of 07 at 594, 530. Compare that with the August number and you can see we're still down 5.4%. So that kind of explains the methodology here. If you look at the chart, what strikes you is there's only one county that is above its prior peak, and that is Orange County at 789,000. Here's a look at the Central Coast. Every county in the Central Coast is still below its prior peak, with San Luis Obispo and Santa Cruz, which kind of, you know, are the north and south nexus of the Central Valley, being the closest to that overall prior peak. In the Central Valley, every county is still below that prior peak. And let's look at the Bay Area. In San Francisco, the median home price is 42% above the prior peak. In San Mateo, it's 34.8% above the prior peak. In Santa Clara, it's 32.9% below the prior peak. So 2 comments. You don't get a lot of opportunity in the social sciences to do a lab experiment. And I feel that San Francisco and the peninsula through Silicon Valley is really a lab experiment. We've got a petri dish where we have job growth and we have income growth and we have household formation, and we don't have anywhere near a matching supply response. So what happens when you have those conditions with very strong growth on the demand side and not a robust response on the supply side? So what you get is the kind of appreciation that we've seen. I also want to say that comparing today with the peak of the 2005, 6, 7 period, in no way is meant to suggest that that was kind of an equilibrium price, even though it was. The prices that we experienced at that time were not sustainable. They were driven by a bit of a frenzy, a bit of a laxity, if you will, in the lending environment. But I still think it is a relevant benchmark, because as a home owner, they will be looking back to, okay, you know, I bought this house at X, and at the peak it was at X plus whatever, and now I'm here. So let me see kind of where I am in that trajectory. And by doing this, it does give us a way to compare how the different regions within California are doing. So I do not mean to indicate that I think the 2006 or 2007 prices were sustainable. They obviously were not. But in terms of where we've come since then, I think it's very useful in looking at the regional disparities. So the CEO of the California Association of Realtors is Joel Singer, and he made this comment a few months ago, and it really stuck with me. At some point, a supply problem becomes a demand problem, and that alludes to the point I made way in the beginning of this webinar. The challenge of affordable housing and lack thereof will and is beginning to impact our ability to be competitive as an economy, right? We are the 6th largest economy in the world if we were looked at independently of the rest of the country, but we can't maintain that if we don't have an infrastructure that supports affordable housing. So that really is the challenge. In August, we had 2.9 months of inventory statewide. The lowest inventory, as you can imagine, was in the Bay Area, which was even tighter than that. We started calculating the statistic in the 80s, and until about 5 years ago, I would have said normal inventory is a 6 to 7 month supply. Today, I will say there has been a structural shift that I don't see returning back to that normal. I think the new normal is what we're living today, and that new normal is about a 3-month supply of inventory, and it gets a little bit higher sometimes, it gets a little bit lower depending on market conditions and the phase of the selling season that you're in during the year. But in general, I would say we are in a world where half the inventory that we were used to before is normal. And in fact, the number of active listings in the state is down 11.9% compared to a year ago. So that's kind of where that plays itself out. Now, the most active markets are the entry-level markets, entry-level part of any market, and that's where we're seeing the biggest runoff overall in supply. The demand for entry-level affordable housing is really almost infinite at this point. And at the upper end, we're actually seeing longer times on the market. We're seeing more inventory. Those properties are moving a lot slower than at the bottom end of the market. Here's a kind of a regional breakout for data in August, and you can see, as I mentioned, the San Francisco Bay Area is the tightest overall in terms of inventory. This is a breakout by price category. So as of August, for properties priced over $3 million, there was a 9.7-month supply on the market. For properties priced between $300,000 and $500,000, so just a little bit shy of the statewide median, we had about a third. It was a 2.7-month supply of homes on the market. So that's kind of another way to look at the differentiation of the market segments. So we have to ask the question, what's going on here? Why do we have such a extreme supply situation? And one of the biggest answers to that is people aren't moving as often. On average, the California housing stock today turns over about 4.6% of the total turns over every year. This is data from 2016. Look back in the mid-70s, it was 7%, it was 8%, it was almost 9% turning over at an annual rate. And this isn't just a California phenomena. You can also see that nationally the turnover rate is lower. And there are a variety of reasons for this. One of them has to do with capital gains. There are, particularly in the high-end coastal markets, households with more than $500,000 in gain that they would be paying significant taxes on if they moved, and they are not anxious to do that. There is also, and this is unique to California, a property tax benefit for being in a home a long time with Prop 13, so not wanting to lose that. They may have refied into a 2.7% mortgage, and as low as they are now, they're not 2.7%, may not want to move. Boomers are living longer. Some of them have to work longer. Some of them want to work longer. The past generation, 40, 50 years ago, their ideal retirement was moving into an adult community and playing golf. And there are a lot of people today that look at their retirement as wanting to stay in the mix, wanting to be active with what's going on in their profession, wanting to rock climb, whatever it is, they're a lot more active. And then finally, there is the reality that you can sell your home very quickly, but if you want to buy in the same area, you're going to be put into competition with a lot of other into a position of competing with a lot of other people for the limited supply on the market. So that's kind of why we are where we are, and it's a lot of kind of complex issues. So I've mentioned affordability a lot. We have calculated an affordability index at CAR for many, many years. There are a variety of ways to measure affordability. In my view, the methodology is important, but looking at trends over time and looking at regional comparisons is really what you're trying to do here. So we do a construct where we ask what percentages of the households that live in a particular county can afford to buy the median priced home. So we're not looking at, can you even find a median priced home? And we're not looking at, you know, I have a tremendous amount of wealth because I've been in a home for 30 years. We're just saying how many of the households based on their income could afford to qualify to buy that median priced home. Nationally, the number is 52, 53%. Statewide, it's 29%. And as you look to the right of that graph, you can see LA is about the statewide number. The Bay Area, San Francisco is at 12%. And it's the Central Valley counties where we're seeing the kind of affordability that competes well with the national numbers. It's just we don't have the job growth there that would be helpful. If you sold someone a house in 2011 or 2012, you did them an incredible favor. They bought during the once-in-a-generation opportunity to buy affordable residential real estate in California. And it's probably a good time for you to connect with them and have a little celebration and say, wow, your equity is up 100 grand or 300,000 or whatever it is. Why don't we talk about using some of that to get your millennial child into a home or into a condo at their college? Do something with that equity. And the reason I'm kind of focusing on 2011 and 2012 is because of this graph. If you look at affordability at that time, it was over 50% in California, and now, as you saw, we're down to 28, 29%. So we've come a long way. And again, for anybody that bought during that time period, they made a very, very smart financial decision. Another reason why inventory is so constrained has to do with the fallout from the financial crisis and the amount of investor money that came into residential real estate. That red line here starts in the year 2000 and shows you the number of renter-occupied single-family homes in California. And the yellow bars are the owner-occupied single-family homes in California. And you can see very clearly what I'm talking about. Between 2005 and 2015, the number of owner-occupied single-family homes in California actually dropped. It fell from 6.9 million to 6.527 million. Renter-occupied single-family homes went from 1.94 million to 2.675 million. So you had a resetting there as investors came in to the market. Obviously, with rates very low, if you've had cash the last 6 or 7 years, it's been equities or real estate, right? Those have been your two options. So the investors saw opportunity very, very quickly in the middle of the downturn and came in and bought up properties. In some cases in the Central Valley, they were able to buy at less than replacement costs. The problem with such a constrained supply is that it's not able to keep up with job growth and support the overall economic growth of the region. So in this slide, I've taken some key counties in California and showed you over a 6-year period from 2010 to 2015, the number of new jobs created in that county and the number of new housing units. So in LA, 381,300 new jobs versus 88,134 new housing permits. In San Francisco, 127,000 jobs, 18,000 housing units. In Sacramento, 44,772 new jobs, 10,890 housing units. We are seeing this phenomena throughout the state. We are not building relative to the job creation throughout many, many counties, and it is a huge problem for the sustainability of our economy and economic growth. I now have a couple of slides from a survey that we have done every year since 1981. There will be a separate webinar that will go into much greater detail than I'm going to go into right now, but I love this survey. I use it. It's premiered at the forecast speech at the expo every year because it gives you a flavor for where things are today, you know, in comparison. Obviously, with 36 years of data, we have a great overall time series. So just let me go through a few of those. Who is buying a home in California? 40% of them are Gen X. The median age of buyers is 45. Who is selling homes in California? It is the baby boomers. Almost half of the sellers are boomers, 48%, with a median age of 57. And you know, I look at the silent generation, the 72 and older, and I think, you know, every person without exception that I know who is 72 and older is not silent. They are loud. So I think maybe we need to rename the silent generation, because they're amazing. They are younger than ever. Anyway, one of the questions we ask is, did the property, again, we're asking you about your last closed transaction. We had realtors from all over the state describing in great detail their last closed transaction. So we asked, did you sell above ask? And 33%, 1 out of 3, said yes, I sold above ask. The long-term average is 20%. So we still have a robust competitive market in general, but also compared with our long-term trend. We asked, were there multiple offers? 60% of you said yes. The average number was 4.1 multiple offers. First-time buyers are more likely to encounter a multiple offer situation than anybody else, with almost 69% of first-time buyers being in a multiple offer situation. The other thing that is consistent with the story is much tighter market for entry-level. First-time buyers, 10 days on the market. Repeat buyers, 14 days on the market. But even those numbers are relatively low. The Bay Area has the fewest share of first-time buyers. Southern California has the absolute largest. And then we asked, you know, was your buyer a first-time home buyer? Our long-term average for this number is around 37.4%. The national number is closer to 50%. We are currently a little bit shy of 32%. So first-time buyers underrepresented compared to long-term trends in the California marketplace. What about international buyers, right? How active are they in the market? And the answer is not as active as they were a few years ago. In 2013, 8% of you said you were working with a non-US resident. And today, in fact, the last 2 years, only 3% of you have said you're working with a non-US resident. And the biggest change from 2016 to 2017 has been the drop in Chinese buyers. A year ago, 53% of you with a non-US buyer said China, and today it's 31%. So the capital controls that were put into place and started to be enforced more aggressively at the beginning of the year have clearly had an impact overall in that market. What about all cash transactions? In 2012, almost 30% of you said I was involved in an all cash transaction. That has fallen off since then, and now we've kind of evened out at about 22%, about 1 out of 5 of you saying I was involved. My last transaction was all cash. So we're clearly interested in investors and what they are going to do with the property that they are buying, and also what they're doing with the properties that they are holding. This year, 13.8% of you said you were working with an investor buyer. And what's interesting this year is the follow-up question was always, are your investors going to flip that house, or are they going to rent it out? And what we saw is an increase in flip from 20 to 24%, and a consequence drop in rentals from 80% down to 76%. And this is positive for the market because it means housing stock is going to be put back into the supply, if you will. These properties are getting fixed up, we used to say turnkey, now we're saying Pinterest ready, right? Everybody's expecting a Pinterest ready property, and they're coming back. They are coming back in the overall market. We've talked about rising prices. That's reflected here in the net cash gain to seller at $200,000. We have not seen this in 11 years, a net cash that high. It seems like a lot until you start to compare it with the median prices in some areas, but we're very happy to see that, that recovery. We looked at a slide earlier with Census Bureau data showing the rate at which properties are turning over. And I also mentioned that on average, people tend to be in their homes close to 20 years in California. But here's another way of looking at that phenomena. We asked you, how long had your seller been in the home? And the average this year was the highest we've recorded in the 36 years we've been doing the survey, 11 years. So compared to where we've been at all-time highs in terms of people holding on to their properties. About 54% of you said your seller was planning to buy another home, and that is also correlated with age, with millennials having the highest percentage buying another home. And then we asked you, where is that seller going? Are they staying in the same county? 38% of you said yes. Are they moving within California? 20% of you said yes. Are they moving to another state? And this is something I want to hone in on. 28% of you said your seller was moving to another state. In 2013, 19% of you said your seller was moving to another state. So an increase of 9% over the last 5 years in people moving out of state. And you won't be surprised to have me say that that reflects the housing shortages and the price of housing in California. So we'll be watching that very carefully. We also ask very detailed questions about financing. I only have one right here showing you the decline in the utilization of the FHA program from 2009 to the present. Only 14.8% of you said the buyers used an FHA loan, and 5.8% of you said it was a VA loan. And then finally, my last slide from the annual market survey, we asked you how your client found you. Now, there are a multitude of studies out there that ask, how did you find your realtor from the consumer's point of view? And they tend to, majority say either prior experience with the person or I found them on the internet, right, is a common response. So it's very important to understand the methodology. We're asking you, the California realtor, how your client found you. And if you look at the top 5 responses, they all have to do with either a prior transaction or a referral or a recommendation. So I want to highlight that in a world where it's all about clicks and leads and portals, to show you that there is a significant amount of connecting between clients and realtors going on in the traditional fashion, right? Which is, we've worked together before and they were terrific, or my friend, my coworker highly recommended this this realtor. So we've had an ad campaign the last couple of years. It's been very popular. The tagline is, "Who's your realtor?" And this data, the answers to this question, I think really reinforces why that has been so popular, because it really rings true. Now I'm going to take you very quickly through a road trip through California, and I'm going to start at the very, very top of the state and show you what looks like a very affordable median at $390. Appreciating at the high end, 9.9% year over year, and a healthier inventory than in other places, but still pretty tight at 3.6 months, price per square foot $213. So here are our Northern California counties. Here you can see the year-to-date changes in sales, that whether they're positive or negative, most of them are within fairly narrow bands. Here is a look at the median prices with Siskiyou at $212,000, an increase of 4% on a year-over-year basis. And down in the south, which is much Yolo County, which is very close to Sacramento, and you've got that commuting going on, median home price up 8% and a median of $445,000. So that's Northern California. Northern wine country. So this data was pulled for August of this year. It is not going to reflect the impact of the fires that, on the one hand, accelerated sales of existing properties as people who lost homes went in and grabbed up what was left, but on the other hand, will really have a diminishing impact overall in the market because of the destruction in the I don't know what the final count was, but it's over 6,000 structures that were destroyed. So median home price $613, 3.5 months of supply, and price per square foot, now we're getting up there a little bit, $359. So here you've got Mendocino, Sonoma, and Napa year-to-date sales. And again, when you see the drops, understand that that's not a demand side issue, it's a supply side issue. Median home prices in Sonoma and Napa are above, right, our statewide median, but compared to the Bay Area, they are the affordable alternative at $626,000 and $654,000. What about the Bay Area? So this is the region with the highest statewide median at 856, the tightest inventory at 1.9, and the highest square footage at 489. So here's a look at those Bay Area sales. And here's a look at median prices, which with, again, San Francisco and San Mateo and Marin and Santa Clara all at or above $1 million. What about the Central Valley? Again, affordable alternative at $315,000 inventory, higher than we saw at the Bay Area, 2.8, and the lowest price per square foot at $185 per square foot. So there's a look at our beautiful, robust farmers market basket of the country, Central Valley. And these again are the year-to-date sales 2017 compared to 2016. And here's a look at median prices, with the highest medians being the areas that are closest to an urban employment center, be it the Bay Area or be it Sacramento. What about the Central Coast? That's a very hot area. I was able to speak in San Luis Obispo last week, had a wonderful horseback ride above the Madonna Inn. It's an absolutely gorgeous area, and I am not alone in thinking it's a fabulous area. There is a tremendous amount of in-migration and demand for properties in the Central Coast. Median price $635, inventory 4.3 months, and price per square foot $376. You can see we go all the way from Santa Cruz at the north down to Santa Barbara in the south. And again, we are looking at countywide data And just as an example, in Santa Barbara, you've got two very distinct areas. You have North County and you have South County, with the South County medians much closer, somewhere around 900,000 at this point. The North County much more affordable. Southern California, median for the area as a whole, and you've got the Inland Empire that's providing the affordable housing stock, a median of 528, unsold inventory at 3 months, and price per square foot, $301. So here's a look at year-to-date sales in Southern California, with some fairly strong sales growth in San Bernardino and Riverside, as people, you know, it's kind of like, what is the line, drive till you can afford, right? Keep driving until you can afford something. And thank goodness for those two counties that offer an alternative to the high-priced coast. And here's a look at the median home prices. So we've got Orange County leading the pack at almost $780,000, and then compare that with Riverside and think about your desire to perhaps make that drive to keep that overall job. So what's our forecast? I started by surveying our board of directors and asking them what they thought was going to happen, and it was pretty terrific. The wisdom of crowds seems to be operating here. I asked them how they would describe the market in their area. 43%, the majority said it was just right, and I love that optimism of our members. 37% too hot. Only 1 out of 5 thought it was too cold. And then I asked them, what's going to happen to the market? And here's what they said. Prices up, agreed. Sales, flat, down, up. We have a modest 1% forecast for sales. So I think that's very close to same or flat, actually. Inventory, 42% thought it wouldn't change, but 39% thought it would be down. We don't do a formal inventory forecast, but I would be in the down category for sure. What about rates? 2/3 of them are in line with our forecast. Rates are up. And almost everybody, 3 out of 4, agree that housing affordability will be more constrained, will be worse next year even than it is this year. So here is our 2018 forecast, with a modest 1% increase in resales. And again, just to reiterate, that's not a lack of demand issue. It is a supply issue. Median price, 4.2% gain for the median as a whole, with the upper end flat or plateauing, and the entry level high single digits, even into double digits in terms of price appreciation. Housing affordability deteriorating because of higher prices and higher rates to 26%, and an average mortgage rate for the year of 4.3%. And this is what that forecast looks like visually, with the sales there and the bars, and the median price hitting 561 next year. In our industry, we are also very focused on dollar volume. And you can see the dollar volume went from 301 in 2005 down to 121, that's in billions, and will be 239 this year. So we have recovered over the last 7 years, but we're still way, way below that 2005 number. So challenges and opportunities. You know, when you give forecasts, at the end of the day, you often get people asking you, did you think about student loans? Did you think about this? Did you think about that? And the answer is, it's our job to kind of think about everything. But when you do a forecast, you have to simplify. I mean, they just aren't that, they just don't tend to be that, that fine a line or fine a detail. And if they are, it's not that trustworthy. So I just wanted to have one slide where I said, here's our slow moving disasters. We've got a housing affordability crisis. We have a pension fund crisis in California. We have a retirement crisis with respect to boomers who haven't been able to save enough. The millennials with student loan debt are a constrained group. The fact that we have such a tight labor market and yet the working class has not experienced much wage growth, I think is a real concern. That our income distribution is, most of the gains are going to the upper end. The institutional ownership of single family houses is something that we think a lot about because they behave differently than a homeowner that has skin in the game with respect to their home when things might get tough. And I shouldn't really call tax reform a slow-moving disaster anymore because it's moving very, very quickly. I hope that you have all responded to the NAR call to action. We have a tremendous amount of information out there on why we are so opposed to the plan as it has been outlined, because even though it preserves the mortgage interest deduction, it does not allow a deduction for state and local property taxes, any state and local taxes. And that is a huge problem, right? And it also doubles the standard deduction. So the great majority of people that claim the mortgage interest deduction today won't be claiming it because they'll be better off with the standard deduction, the higher standard deduction. And then you might say, well, why would we have a problem with that? The problem is it disincentivizes home ownership. The deduction for mortgage interest and state and local taxes is a huge incentive for home ownership. And we don't want to give that up because it's not good for homeowners. It's not good for the economy. It makes housing more expensive. So if you want more information, more detailed, it's on our website. You can always email me directly, but I hope that you will be involved and support us on tax reform. I asked in my survey, what is the biggest challenge for the housing market next year? And the answers were right on. Lack of inventory. Half of the respondents said, not enough inventory. 36% talked about affordability. 6% said rising rates. And 6% said they were concerned about the new brokerage models. And 2% thought we might be headed into a recession next year. So I think we're all pretty much in line with that. So in terms of opportunities, we want to always end on a positive note, right? The market is what the market is, and there are always realtors who do great regardless of the market. And that's what I encourage you to do. Understand the market, be able to engage in a conversation packed with value on the market with your clients, but don't let it determine your productivity because it really isn't doing that. You need to figure out or reinforce how you are comfortable doing the business and just do it. Understand why you're in the business. There's a wonderful TED Talk from Simon Sinek who talks about discovering your why. If you're just, they say if you hire someone and they're coming on board for a paycheck, it's not good. You want someone who's passionate, who believes in what they're doing. I think one of the common threads for many of us that work at CAR is that we are passionate advocates for housing and home ownership. And that keeps us going when things get tough. So what is your why? Connect with your reason for being in the industry, reconnect with your clients, understand that first-time home buyers are not prepared with the information they need to make smart decisions in the marketplace. So educate them directly or educate their baby boomer parents and provide them with the information that they need by reaching out to them. And with respect to the international market, and I know that some of you are very active in markets where there is demand from wherever, Canada, China, other parts of Asia, Mexico, realize that for a certain class of buyer looking for properties, we are incredibly affordable compared to capitals around the globe. Compared to Hong Kong and Shanghai, compared to Rome and Paris and London. You can buy a home in Santa Barbara or in San Mateo or in San Francisco or in Brentwood that is absolutely fabulous and is much more affordable than in these other areas. So if you're in that rarefied air, please be encouraged by the global comparisons of housing. So one more thing. I was very interested in a survey that came out in the beginning of the year from Trulia that tried to measure the impact that pets have on homeownership. And so I asked the directors if they had a pet, and 2/3 of them said, yes, I do. So then I asked, is that pet a member of your family? And those of you that have pets know exactly what I'm talking about. And 92% said, yes, my pet is my family. So then I asked, if you were to move, would your pet's needs be paramount in your purchase decision? And I would say that only 13% of the audience were completely honest with me and said, yes, my pet makes the decisions for me. 42% were very strategic. No, my pet does not make the decision, but I do double down on treats. 28% said we have an equal deliberative process, and 16% said I just try to ignore their complaints. So all kidding aside, you know, pets are important to people, and I'm surprised that we don't see more advertising based on your dog is going to love the dog park that's at the end of the street, right? You know, play dates with the pups every Saturday morning at Starbucks, you know, whatever it is, because they are part of the family for most people. So along these lines, I said, as long as we're talking about animals, how many of you have a millennial in your family living at home? And 14% of the directors said yes, they had a millennial living at home. So then I asked the $64,000 question. I believe that the real marker of independence of your children is not a high school diploma. It's not a college degree. It's not their own apartment. It is, are they still on your cell phone plan? And 67% of the directors with millennials at home said yes, their millennial is still attached to them through their cell phone. So if you really want to be independent, you've got to wait until they get on their own plan. So with that, I want to thank you all for calling in. Road, is there some more information that we want to share? Where we will provide the slides to you. In fact, they're already posted on CAR's website. Are there questions? Yeah, the full version of the PowerPoint will be available. You can reach me directly, Leslie A. at car.org. I also have two fabulous senior economists that work with me and do the heavy lifting. So Jordan Levine, who's here with me right now, Jordan L. at car.org, and Oscar Way, Oscar W. at car.org. So that's our kind of group of professional economists, and we are here for you. We're always eager to hear if you have suggestions for survey questions or need some kind of analytics. We have some new dashboards on our website where you can drill down by city, by zip code, and get housing market data. So you might want to look into that. And with that, I just wish you a terrific 2018 and want to thank you so much for joining us today.